In the early hours of February 28, 2026, hundreds of American and Israeli warplanes simultaneously breached Iranian airspace. Operations Epic Fury and Roaring Lion had begun. Military installations, nuclear facilities, and missile launch sites across Iran were reduced to smoldering ruins in a matter of hours. But the bombs were not the fastest thing to travel around the world that day. The economic shockwave was. Within hours of the first strikes, vessel traffic through the Strait of Hormuz, the narrow choke point, through which roughly 20% of all seaborne oil passes every single day, collapsed by a staggering 70%. The ship tracking platform Marine Traffic captured this free fall in real time, and the number sent shudders through every trading floor on the planet. This was not a minor supply chain hiccup. Brent crude futures exploded 13% intraday, smashing past $82 per barrel and sprinting toward 100. Gold rocketed to an all-time record of $5,400 per ounce. As investors stampeded into safe haven assets, Dow futures cratered nearly 600 points before the opening bell, while Tokyo's Nikkei 225 plunged as much as 2.3% in the first minutes of trading. In just 48 hours, the Iran war had sent 7 distinct shockwaves, tearing through the global economy simultaneously. This is the story of how each one of them unfolded. To understand why the economic damage spread so fast, you need to understand the geography of oil. Iran pumps roughly 3.3 million barrels of crude every single day, making it the 6th largest oil producer in the world and the 4th largest inside OPEC. Of that output, approximately 1.6 million barrels per day are exported, the vast majority flowing to China. Every single one of those barrels passes through the Strait of Hormuz. But Iran's own exports are only a fraction of the total. The strait handles about 20 million barrels of oil per day. Roughly 20% of all global seaborne crude squeezed through a waterway, just 33 kilometers wide at its narrowest point. It is, without exaggeration, the single most critical choke point in the global energy system. The moment the U.S. and Israeli strikes began, Iran's Islamic Revolutionary Guard Corps, the IRGC, issued an explicit and public threat. Any vessel attempting to transit the strait would be attacked. The response from the oil industry was immediate and total. Major oil companies and commodity trading houses suspended all crude oil, refined fuel, and liquefied natural gas shipments via Hormuz. According to Reuters, more than 150 tankers dropped anchor in open Gulf waters, unable or unwilling to proceed. Lloyd's List reported that effective transit volumes through the strait had collapsed by more than 80%. The world's energy artery had been severed, with the world's most important oil artery effectively shut down. Global commodity markets erupted. When trading opened on Monday, March 2nd, Brent crude futures spiked 13% intraday, blowing past $82 per barrel, the highest level since January 2025, according to Trading Economics. U.S. West Texas Intermediate crude surged 7.6%, reaching $78.41 per barrel. The price forecasts coming out of major investment banks were alarming. Shane Oliver, chief economist at Australia's AMP, warned in a research note that if the war becomes protracted, oil prices could soar as high as $150 per barrel. Goldman Sachs projected a range of $120 to $150 if the Strait of Hormuz remains blocked for an extended period. Capital Economics calculated that if Brent climbs to $100, global inflation would rise by 0.6 to 0.7 percentage points, enough to derail monetary easing worldwide. The flight to safety was equally violent. Gold futures surged 4%, smashing through $5,400 per ounce to set a new all-time record. JP Morgan raised its year-end gold forecast to $6,300, citing unprecedented geopolitical risk premiums. Fear was being converted into price at a speed. The modern financial system had rarely seen the commodity market panic, cascaded directly into global equity markets with devastating speed. Before U.S. markets opened on Monday, March 2nd, Dow Jones Industrial Average futures had plunged nearly 600 points. S&P 500 futures were down 1.2%, and NASDAQ futures had cratered 1.55%, reflecting raw fear among institutional and retail investors alike. Europe was hit hard. The pan-European Sachs 600 index fell 1.76%. its worst single-day decline in 3 months. Britain's FTSE 100 dropped 0.63%. Reuters described it as the most significant daily loss. European equities had suffered in months. Asia was even worse. Tokyo's Nikkei 225 plunged as much as 2.3% in early trading, before closing down 1.35%. South Korea's Kospi fell 1%. Gulf stock exchanges did not open at all, trading was suspended entirely. But then came the first twist. As the U.S. session progressed into the afternoon, something unexpected happened. American stocks staged a dramatic reversal. The Dow clawed back most of its losses, closing down just 0.15%. The S&P 500 actually finished in positive territory, up 0.04%, and the Nasdaq gained 0.36%. MarketWatch reported that futures markets had overreacted, and aggressive dip buying quickly absorbed the selling pressure. The skies over the Middle East went silent. According to Flight Radar 24, more than 3,400 flights were canceled on March 1st alone, across 7 airports in the region. Dubai International Airport, one of the busiest aviation hubs on the planet, shut down completely. So did Hamad International Airport in Doha, Qatar, and Abu Dhabi International Airport. CNN reported that more than 20,000 travelers were stranded after UAE airports closed, with hundreds of thousands more left, scrambling for alternative routes, many of them sleeping on terminal floors. The financial impact on the aviation and travel industry was staggering. Emirates Airline alone was estimated to be losing $134 million per day during the closure. Shares of American Airlines and Delta Airlines dropped on concerns about soaring fuel costs and collapsing travel demand. But in a mirror image move, the defense sector was surging. Northrop Grumman shares jumped 6%. RTX gained 4.7%. Lockheed Martin rose 3.4%. All three led the S&P 500 on the day. Meanwhile, ExxonMobil hit an intraday record of $159.15, fueled by the crude price explosion. War is a catastrophe for some and an opportunity for others. This brutal asymmetry is the fundamental nature of a war economy. Then came the second twist. In an emergency session convened immediately after the strikes, OPEC Plus announced it would increase production by 206,000 barrels per day starting in April. The figure exceeded market expectations, which had ranged around 137,000 barrels per day. Reuters and the New York Times both characterized the decision as OPEC's preemptive attempt to calm markets rattled by the Iran war. But the market's reaction was ice cold. Compared to Iran's daily production of 3.3 million barrels, the OPEC Plus increase represented barely 6% of the shortfall. If the Strait of Hormuz blockade persists, roughly 20 million barrels per day of crude oil transit faces ongoing disruption, a volume that the 206,000 barrel boost cannot even begin to offset. Capital Economics warned that if Brent crude climbs into the $90 to $100 range, developed market inflation could rise by as much as 0.7 percentage points, and 2026 GDP growth could take a measurable hit. MarketWatch reported that expectations for Federal Reserve rate cuts are evaporating as the prospect of energy-driven inflation reigniting has forced traders to price in a longer period of tight monetary policy. OPEC's output increase was meant to reassure. Instead, it underscored just how inadequate the global supply response actually is. The world's most powerful financial institutions are now sounding the recession alarm. J.P. Morgan Global Research has placed the probability of a U.S. and global recession in 2026 at 35%. Moody's has gone further, estimating the risk at approximately 42%. The International Chemical Information Service, ICIS, has designated a global recession as its central scenario, the most likely outcome of the current crisis. The New York Federal Reserve's own predictive model calculates a 20.4% probability that the U.S. economy will enter recession by December 2026. AMP's Shane Oliver warned that if oil prices rise by an additional $40 per barrel from current levels, the impact would be equivalent to adding roughly 40 cents per liter to gasoline. Prices worldwide functioning as a direct tax on consumer spending in every economy on Earth. Here is the bottom line. In just 48 hours, the Iran war has sent shockwaves through 7 critical channels of the global economy simultaneously: oil prices, Currency markets, stock markets, gold, aviation, logistics, and growth forecasts. And the epicenter of this disruption, the Strait of Hormuz, remains effectively blocked. The economic shock of the Iran war is still in its first act. The second act is being written right now in real time.